en fait, qui est Chief Investment Officer chez Brompton. Et je tiens juste à vous dire que si vous n'êtes pas client, il n'y aura il y aura aucune recommandation d'achat ni de vente qui va être faite aujourd'hui. Si vous n'êtes pas mon client, je vais vous demander de pouvoir continuer cette conversation-là avec votre conseiller en placement. Hi, my name is Antoine. I'm a wealth manager, investment advisor at Richardson Wealth. I'm here with Laura Lau from Brompton Investment. She's the Chief Investment Officer. Today, there will be no recommendation or buy or sell. So if you're not my client and you look at this video and you're interested in tech or the product, it's a conversation you should have with your advisor moving forward. So thank you, Laura, for making the time. I appreciate, and I also loved our last conversation. You talked a lot about artificial intelligence. I know it's very dynamic. So how do you approach your stock selection in that specific sector?
So I think, first of all, I think you're in for a treat today because, we're talking about technology. And Varun and I, we've actually worked in technology. We're both programmers and we're both engineers. So I think we'll give you a lot of more in-depth responses than you can get anywhere else. So first of all, for artificial intelligence, as you said, it's very dynamic. So right now we are in the early stages of artificial intelligence. And when you're in the early stages, the best way to approach this is what we call the picks and shovels, really the companies that build those tools. So, and what I mean by that is, for instance, the building blocks right now for artificial intelligence is semiconductors. And there's only one game in town, it's NVIDIA.
Yeah.
They have about 80-90% of that market. And as that market matures, we're starting to see those first movers would be like, say, Microsoft. They've very quickly embedded AI into a lot of their tools. And, we're starting to move through the other software companies, such as, Adobe. In Adobe, if you can't draw like me, you can actually type in a sentence and ask it to draw for you. You can say, I want a big bird. No, I want an orange bird. I want it standing. I want it flying. I want, a purple beak. You can do all that and it will draw that for you. So that's why those are some of the early movers. And we think with time, the companies that really can use artificial intelligence to get more customers at a cheaper price, to be more efficient, will be the ones that will benefit.
Awesome. Well, thanks. Speaking of AI, it's a true evolution, especially for I that started to play a little bit with the Chat GPT, not to name it, but as an example. Is AI a true revolution and a change into our society, or you only see it being a short-lived frenzy for the market?
We think that we believe it's real. We believe it's the next industrial revolution. But, consumers like you and I, we're very fast. But we find companies, it takes longer for them to actually make these big changes. So productivity gains for companies will take longer. And as I said, the benefits will actually go to those that are able to implement it best. Because I think this could put companies that do not implement it well out of business.
I agree. I agree. For some, it will be longer, but I'm pretty sure that Amazon they have AI in the background, but you and I we don't see it right now. So I
Yes.
think it's a good example. Well,
But
tech can be very
So Vroom had
yeah,
something he wanted to say.
yeah.
yeah,
Please,
just to add
please.
to what Laura was saying, I mean, yeah, you're gonna have like near-term disruption on the labor force on AI, and obviously a lot of it we can't see. But to me, like AI is gonna augment human productivity, and I'll give an example, right? Like, so you mentioned Amazon, so robots they use robots to transport cargo in the Amazon warehouse. They shuttle all the materials from the shelves to the conveyor belts, right? Robots can lift heavy tons more than a human can. But what robots cannot do, they cannot pick and pack. they lack dexterity in the robotic movement. So you need human labor to actually pack the boxes. But the robots will bring the items to the humans, right? So that's one way of AI augmenting human labor, making these workers more productive. Another example I'll give you is there's a study done a couple years ago. It had this like AI algorithm reading breast cancer scans, right? Obviously, they're reading these scans faster than radiographer would do, right?
Right.
What they realized is that the algorithm plus the doctor, they were able to lower the error rates, improve detections of the cancer
Yep.
versus the doctor itself versus the machine by itself. So
I
these
agree.
are things that are real life examples. It's more than just a hype. It's actually here to stay. It's going to augment human labor, and over time, it's actually going to start displacing human labor.
You know
But
what? Do you know? Sorry to interrupt, but I was in Vancouver for the CSAP Congress last weekend, and I was speaking to a resident in Ottawa, and I think Ottawa has the first or the second device. So imagine you're your home in your office, you're the top surgeon, but you could manipulate in your office the robot operating a human in Edmonton, Chicago. So I was very impressed of, geez, it's going to the next level. So I mean, it's a way to augment the productivity, but the effectiveness as well of a surgery.
yeah, and in addition to the augmentation of human labor, it actually opens up new avenues or new job areas that didn't exist before. Because to use an analogy, when the ATM machines first came out, like, oh, the banks gonna have to close down their branches, yada yada. No, the banks open more branches.
Yeah,
Oh, tellers are gonna go out of business. No, the tellers move from teller services to advisor services to higher touch point services.
right.
So you see that in the worker. Whenever there's a new technology, there's a little bit of disruption, but people get carried away. Oh, it's going to displace human labor. No, it's going to augment it and create new jobs that never existed before. Right? So you're
I
going to see that.
agree. I agree, but yet it's the human nature to be reluctant to some change, right? It's been that for decades, and I unfortunately it's going to stay like this. So speaking of tech, you guys all know that it could be very volatile, and a lot of investors, my client included, and some managers sometimes they want to hit the home run, every time. So can you explain us more about your investment policy?
Okay, great. So tech, as you said, it tends to be winner take all. The strong get stronger. So it does make sense to let your winners ride, but you also need to manage that risk. So for instance, if you own the XLK, which is the ETF for um, the S&P 500, the US, 25% is Microsoft, 25% is Apple. So what happens if something goes wrong with one of those companies? It could be the government comes down on you for antitrust. It could be your iPhone is not selling as well, right? So we think that it is prudent to manage that risk. So we typically have a maximum about 7% on any holding, and we do pare it down. We start reducing weight before that. Uh, and the other thing we can do is we can write calls to reduce exposure and reduce the weight in the fund. Uh, so so that's typically what we do. And Vroom also wants to explain the barbell approach we take.
Sure. So to add on, what Laura touched upon on the risk management side. I mean, at the end of the day, portfolio managers are risk managers because we have to
Right.
manage the portfolio. So the way we construct the portfolio is picture it as a barbell. So we have growth tech on one end,
Mhm.
value tech on the other end, and in the middle, what I like to call growth at a reasonable price, the GARP names, right? So when you're on a risk on regime, kind of like tilt more to the growthy names. When you're on a risk off regime, you tilt more to the value oriented names, and that gives you consistency on returns at a lower risk point, rather than you're just chasing all the momentum growth stocks when the market turns and you're gonna have a huge drawdown, right? So
Right.
that kind of manage the risk in the portfolio, keep it balanced, and over like period of 3 to 5 years, you're gonna see consistency in the return.
So you guys just spoke about covered call. In today's market, how does it apply and how impactful it is in your portfolio?
So as you said, tech is a volatile sector, and you have, high risk of drawdown for any one single. So that's why a portfolio makes sense. And also, because it's volatile, we get what the cover calls, we get premium income in. So this is one sector where we get paid a lot of money because of that volatility. So what the call writing does is it converts some of that volatility into income, which lowers the overall volatility of the portfolio. So that income does cushion that volatility. It also forces discipline to sell stocks when they've run up too much or when they get expensive. And what we do is we selectively, right? Because sometimes it's a good time, sometimes it's a bad time. So we actually make a conscious call when it's a good time, when it's not, or we're getting paid, just do it. And so we can lower that volatility of the portfolio.
Awesome. Well, my next question is I think it's not funny. It's I do not want to compare people, but you've all my clients, when my client speaks about it, or the taxi driver, it's you need to run away sometimes. So I do not want to name drop, but Cathy Wood has become very popular with ARC. But surprisingly, I think was it last year or in 21 they created an ETF with the S in front to short Cathy Wood, Shark, I think,
Yeah,
if I'm
yeah,
not
Sark. Yeah,
mistaken.
Sark. Yeah.
So how can you explain the main difference between your mandate and her? I understand it's a silly question and it's compare black and white, but just to educate a little bit more my client or investors about the prudence that some should have.
Okay. I actually have a chart of the performance. I don't know if I'm allowed to show it, but you can see it's quite telling because what Cathy Wood concentrates on are those emerging early technology um, companies, which we call unprofitable tech
Yeah,
companies.
totally.
So
Yeah,
that's what she does. She goes after unprofitable tech, which of course are very volatile because there's no earnings. So you don't have any valuation to hang your hat on. And currently, these small companies are having a lot of trouble getting funding from venture capital and banks. So this current environment actually favors those larger, more established companies that actually make money. Because we've
right,
seen in the past that these bigger companies can outspend and kill smaller companies, right? We've seen that, right? Say Snapchat, oh, the kids get on it, and then Facebook copies everything they do.
right,
So, and you've seen, even OpenAI, they need a big partner like Microsoft to fund that research and development. So, Brompton concentrates on those bigger, more established companies that actually make money. They can invest money in research development. They are the beneficiaries of scale. And they also have low levels of debt, which is very important in this high interest rate environment. And a lot of them have actually a lot of debt. So, sorry, actually have a lot of cash. So as I said, I don't know if I'm allowed to show for compliance purposes, the art
let's
chart.
let's say let's say no for today.
Okay,
and I
no
and I
problem.
will ask, because if not, then we're gonna ask to edit the video. But let's play on the safer side today. But
Okay, okay.
to resume, I guess that choosing you is choosing Brompton in your team is choosing a partners that will do their good due diligence and not go and pick an environment there's no revenue. Think you guys are managing the money how I would like my managers to manage money. I mean, with revenue, if there's no revenue, for me it's the first question I have. You make no cash, well, that's the end of the conversation. Speaking of again tech, what would be the lagger moving forward? What would be the best opportunity for a solid future growth?
Okay, so you want, I guess, best opportunity for future growth and what is a laggard subsector in tech? That,
Yeah.
that okay, perfect. So I mean, the solid future growth opportunities, as Laura mentioned earlier, I mean, this AI revolution, the picks and shovels are the semiconductor guys. They're going to lead, um, the tech market up. They're very cyclical. And then, as the AI theme matures, you're going to have the software guys getting, getting their day in the sun, so to speak. As you get more AI in enterprise software. I mean, we've seen it in consumer software with ChatGPT and Siri and all that. But the first winners would be the semiconductor guys, followed by the software guys as they build more AI capabilities in their offerings, right? The laggards, I think, would be, and this is very specific. It's the hard drive guys, the Seagate and the Western Digital. To me, that subsector is very commoditized. There's not much net new innovation that can really drive margin expansion in that subsector, and it's a commodity. And I agree that there is demand for memory, especially with AI. You need to have, to store all this data and stuff. But the innovation that goes into hard drives and solid state drives, it's not going to be leaps and bounds as you see in semiconductors or in enterprise software. So those guys would be the laggards. And so, I mean, it's all centered around this whole AI theme, because to me the AI theme is multi-legged, it's multi-pronged. It spans not only tech but outside tech, like healthcare,
Hmm.
industrial,
Hmm.
transportation, like finance, right? And it all boils down to that silicon fabric that powers AI. So these guys are just going to be the natural leaders, next growth opportunity.
Last time we spoke, Laura, it was very interesting. And the next question is about geopolitical, like how it could influence AI. And I'm still very impressed about your wisdom, how you see this dynamic plays out.
So what we're seeing is that the US is really trying to slow China's advancement of technology. They're trying to limit the faster chips from being sold to China. So we saw yesterday that NVIDIA said they may have to cancel $5 billion worth of orders to China. That's less than 10% of 1 year of their sales. What's likely going to happen is they sell it to somebody else and and the black market or whatever, or they resell it to China at a higher price. So they're going, so I don't think those sales are lost. And Biden has also started issuing executive orders around AI, testing AI models, privacy rules, and I think the EU will likely do the same. So it might slow it down, but the truth is governments don't even understand, you know, especially congressmen. Some of the questions they ask are hilarious. They ask companies about search, and Apple's like, well, we don't do search. So the truth is they don't understand technology. And tech companies have found a way to do business and circumvent the rules. And we think, this will continue going forward. And geopolitics can also help. So we saw with the CHIPS Act in the US,
Hmm.
the government's spending a lot of money to help build more semiconductor plants. And Japan's doing the same. So, Varun, did you have anything else to add?
Yeah, and in the geopolitical landscape, and it's so dynamic, and these companies, they're workarounds. I don't know if you recall back in 2019 when Trump slapped the tariffs on selling some kind of technology to China, and what they did, the companies lobbied Congress. They made these one-off exclusion lists, right? And they had these back channeling to able to sell some sort of semiconductor technology to China. So it can happen again. Lobbyists come in, they create these exclusion lists. Okay, yes, you can do this, yes, you can do that, and then they can sell their product through, right? They may not be able to sell the high-end AI semiconductor solutions, or but they can sell the medium level stuff, the low level semiconductor solutions to China, right? But I think there's a lot of back channeling that they can do that to kind of like work around it on the periphery, right? So
Interesting. We all heard about interest rate. We would hope it would start to go down next year, but how high interest rate are impacting e- the portfolio and the tech sector in general?
sure. So I mean, interest rate is one thing, but I think the real question is the pace of that rate, because we saw like rapid tightening would, you see a lot of multiple compressions coming down. Where these tech stocks get hit is in the unprofitable tech names, stuff that are speculative. They get significant multiple compression versus a stable cash flow generating stock. Um, so, you know, as I mentioned earlier, we have this barbell approach, right? We have the value both at a reasonable price as the barbell, and then the other end, growth stocks. So when the regime is shifting, you shift the barbell, right? And in a high interest rate environment, the market wants cash flow. They want dividend paying stocks. They want stocks that companies that buy back their shares, like return of capital to investors. And that's your value oriented tech. They are like tech names that pay a decent dividend yield. Some of these semiconductor names, they pay a yield, right? And some of these like IT services and some of these larger enterprise companies that they pay a decent yield, and they do have a significant share buyback policy, right? So our portfolio construction, kind of adapted to the shift in interest rates. But I do agree that the pace of the interest rate trajectory impacts tech sector as a whole, because you just get tech is higher beta, you just get multiple compression, but you get some insulation in that downdraft from holding like value into tech cash flow generated companies, which is what our fund focuses on.
Great, thanks. Following that question, do you believe that we could see more pressure on the tech stock if the 10-year yield continue to rise? Or you
Yeah,
think it's currently priced into the rate?
yeah. I mean, I think it's more on these surprises, and you can have a stable trajectory up, and I think it's not going to impact the valuation on tech as a whole significantly. But when you get these nasty surprises, and I think that the Fed is guided by the data dependent, inflation. If you get a nasty inflation print, well, guess what? The Fed is going to have to increase interest. They have to respond, right?
Right.
Would impact the tech sector because it's a higher beta sector, right? But within that, you still have your value tech would be less impacted versus unprofitable tech or a high beta name or a very growthy name, right? So yeah, the sector will be impacted, but at the same time, there's light at the end of the tunnel, right? Once you start peak interest rates, you start coming down, then guess what? People are searching for growth,
Yeah.
and the sector provides that growth versus any other sector, right?
And many are talking about mild recession. Again, I don't believe you and I have that crystal ball, but if it happens, will the tech sector get hit more than other sector?
Well, I mean, I think the last year when you saw like a bunch of like I guess restructuring from these large organizations, they kind of laid off some of their global staff, and they did a lot of cost optimization and cutting back spending like on the marketing and just like employee frills, like whatever fringe benefits you had to kind of cut back on. But I think they're well prepared for a recession, from because they took the early, right? I'm sure. I mean, there's always going to be like layoffs and downsizing, but you know, tech is a very agile sector. They kind of prepare and they rebound quickly
Yeah,
on the upswing.
right. You're
And
right.
so, like initially there's a knee jerk reaction. Well, at the bottom of the recession, guess what sector lifts up the market? It's tech, and it's
Tech.
just exactly. So, and again, going back to our barbell approach, I mean, you want to have a strategy or product where you can like play the market regimes, and you're not fixated to one particular regime style. So, you want portfolio manager to adapt the portfolio to, recessionary forces, high interest rate, and then when you turn, you can adapt the portfolio to low interest rate environment, right? So you want that agile capability. And the tech sector is very agile. I mean, even the subsectors within tech, there's huge dispersion. And then you can play that depending on your view, your macro view of the market, your risk indicators and so forth, right? So we kind of do a lot of that. But again, recession, yes, tech will get hit, but I think they did a lot of pre-planning ahead. But on the upswing, tech will lead us out of the recession.
And on top of it, you guys are writing calls, covered calls. So
Exactly. We're harvesting that premium on
right,
both ends of the
right.
spectrum.
So I kept my last question for the end because it's always a question I love asking managers, because most of managers most of the time they speak about the good things and how things work out. So I would like to hear uh, a deal that went south? I mean, a wrong acquisition, a wrong add to the portfolio, and what do you guys have learned from it?
Sure. So this example is actually it did work and then it stopped working. So I don't know if that fits your criteria, but there's this. And just to give you a overview of the company is called ASML, stands for Advanced Semiconductor Material Lithography. They're the only producers of the machine that prints these microchips, right?
Okay.
They're, there are competitors, but they're the only ones who do it in such a small scale. They're down to like the 5 nanometer, 3 nanometer scale, right? And so they have a monopoly, which means they have pricing power, right? Taiwan Semiconductor uses their machines. Intel, Samsung, anybody who prints chips uses ASML's machines, right? It's very technical. It's I mean you're using lasers to kind of like guide the UV light to etch the silicon wafer at a 3 nanometer, scale in a vacuum. It's a very complex process. They took a decade to develop this technology, right? Um, so we held a stock in our tech portfolio. It did well, but then what didn't start to work was, the stock fully reflected what Laura spoke about with the CHIPS Act. So the market fully priced in. Okay, everyone's going to procure these machines, and then what started to happen was you start getting demand was robust, but you start getting order slippages on these machines because it takes a long time to construct these machines. They're big, the size of like it's a huge footprint of these machines, right? And they could only produce a certain number per year, so then it's easy to get these orders slipping through. And
Mm.
once you start seeing that, well, guess what? The market's not going to like that because it takes a longer time to realize that revenue. So that starts that worked against us in the stock, but we were quick to realize, okay, you know what? There are better risk rewards in the semiconductor space because we like the space. Maybe not in ASML, but we added to Nvidia and we added to some other semi names that we was a better risk reward profile. So I think the overall view is like it's great when you find an investment thesis that works, but be prepared to switch when it stops working and don't catch a falling knife, right? So manage your risk. And it's a good company. It's like I said, monopoly, pricing power, it checks all the boxes. But when the market is working against you because you're delaying, you're seeing some order delays, you got to right size your portfolio, and adjust accordingly. And know when you're wrong, right? Which is what you did, and lesson learned, right?
Thank you, guys. Thanks for your time. 28 minutes. We did it in less than half an hour. Mission accomplished. Thanks for your insight. Thanks for your transparency and honesty. It's always a pleasure to work with you. Let's do that in May or June next year, if you don't mind. Thanks, Laura. Continue your great work. We appreciate everything you guys are doing for us.
Okay, thank you, Antoine, and
Yeah.
thank you for having this. And we're always happy to educate, investors.
Thank you. Thank you. Thank you, guys. So I'll just share my screen for the last time for the disclaimer. Again, um, thank you for your time, and we'll speak soon, guys.
Okay, bye.
Okay,
Thank you.
bye.
Bye.